Good evening, everyone. I'm pleased to welcome you all to this conference call to discuss our Q2 and H1 FY2020 results. Our results Piramal, Mr. Vijay Shah, Executive Director, Nandini Piramal, Executive Director, PEL, Mr. Khushru Jijina, Managing Director of Financial Services Business, and Vivek Valsaraj, CFO of the company. With that, I would like to hand it over to our chairman and would request him to share his initial thoughts. Over to you, sir.
My best wishes for the Diwali season now to all of you. Let me now share with you the numbers of and the performance for the first 6 months of the current year. During the first 6 months, our revenues grew by 18% to 7,110 crores, and the profit before tax and exceptional items grew by 25% to 1,338 crores. The net profit is 19% above the same period last year at 1,029 crores. For the second quarter this year, revenue grew by 15% compared to the same quarter last year and is now at 3,604 crores. And our profit before tax and exceptional items grew by 29% to 733 crores, and net profit grew by 18% to 569 crores. I'm very happy to report that if you look at our 5-year performance, the revenue CAGR for the 5 years has been 24%, and net profit during this period has grown on a compounded annual growth rate of the business activity in India has been facing a slowdown. In fact, the June 19th quarter was one of the weakest in the last 6 years, with GDP growth rate slipping to nearly 5%. Liquidity tightening in the NBFC sector has accentuated this impact. Real estate and the MSME sectors, which are crucial to GDP growth and employment, continue to be impacted by shrinkage in credit flow. As per the RBI data, total credit flow to the commercial sector has fallen by 2.25 lakh crores between April and mid-September this year compared to an increase of 2.6 lakh crores for the same period last year. The new credit provided by housing finance companies for the MSMEs, 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 the credit grew only by 12% year-on-year as of June 2019 versus 23% last year. While banks have more than sufficient liquidity, there is still a lack of confidence to fund NBFCs, who are lenders to these important sectors. We've said this before, that in such times it's only few NBFCs and housing finance companies which have a high capitalization, strong parentage, best-in-class governance, robust risk management and processes, and deep sectoral understanding would survive going forward. And we can already see this consolidation taking place. Before I talk about performance of the financial services business in detail, I'd like to share with you some headline numbers. Repay borrowings, 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 repayments and prepayments, and these inflows are equivalent to 85% of our loan book. During this period, we've raised 24,000 crores of long-term funds, which also reflects the confidence of lenders on the quality of loan book and the underlying assets. In addition, we received 19,000 crores, which is 35% of our loan book, in the form of repayments, prepayments from borrowers in the last 1 year, reflecting the high quality of our borrowers and their consistent trend in the sales. What is reassuring for us is that of these repayments, prepayments, nearly 7,700 crores was through refinancing from banks, mutual funds, and other institutions without any discount, reflecting our client selection and quality of underwriting. During this period, we've disbursed 19,000 crores in the last 1 year to meet existing commitments in wholesale lending and as well as growing our retail housing finance business. Debt obligations of 30,000 crores in the past 1 year have been met, and they have been all paid on the due date. These numbers reflect the core strength of our business. What have we learned from the last 14 months? While our strong fundamentals enabled us to navigate through the liquidity tightening period, some of the learnings are that we have to be more conservative in our liabilities and see that the long-term funds, we have more long-term funds. We've also realized that building a diversified and granular loan book is important, and we have decided to bring down our single borrower exposures. During this period, we have taken several steps to further strengthen our assets and liabilities. On the liability side, we did have a larger proportion of short-term borrowings. We are continuing to improve our borrowing mix by shifting towards long-term funds. During the past year, we have raised long-term debt of 24,000 crores. Bank borrowings now constitute 69% of overall borrowings, significantly higher than the 49% we had in September 2018. Although we did resort to some short-term borrowing during the last few quarters, we have reduced our exposure to CPs from 18,000 crores, which was at the end of September, to 1,480 crores at end of September 2019. More importantly, CPs from mutual funds have reduced to nearly 615 crores compared to 15,600 crores a year ago, and by the end of November, we will have no CPs from any mutual fund. During this period, because we have focused on improving our liquidity, there has been some increase in borrowing costs, and we've seen a temporary rise. The average cost of funds was 11% during FY20's first half. We expect that borrowing costs will normalize in the next year. We are already seeing yields going up and believe that they will continue to go up further as the competition is down significantly in the spaces we operate in. As done in the past, we remain confident of fulfilling all our short-term and long-term repayment obligations. Coming to the asset side, our loan book remained flat at 53,000 crores at the end of September. This has been a deliberate strategy as we believe that in an uncertain, turbulent market, it is important that we focus on liquidity and focus on seeing that the current borrowers at whom we have funded their projects remain on track rather than going for new businesses. Even in this challenging time, our gross NPA ratios remain below 1%, which they have done for the last 14 quarters. We have diversified our loan book. The wholesale residential real estate loans, now at 25,600 crores, constitute 48% of the loan book compared to 79% in March 2015. Our wholesale commercial real estate loans at 11,400 crores now account for 22% of the loan book. The corporate lending remains unchanged at 18% and stands at 9,600 crores. Our housing finance loan book is today at 6,400 crores and accounts for 12% of the overall loan book compared to only 4% a year ago. We have dispersed 5,000 crores towards retail in the last 1 year. We've also taken steps to reduce the single borrower exposure, and large exposures have been reduced either through refinancing and co-origination. The top 10 exposures now account for 30% of our loan book, and we plan to reduce this to below 20% by the end of the current fiscal year. The environment for NBFCs is that there is significant consolidation taking place in the industry, and this gives us several substantial and profitable growth opportunities because we are well capitalized. As I mentioned already, we are seeing an improvement in yields, especially in the wholesale lending business, as we have been able to largely pass on the increase in costs of borrowings to our customers. However, given the uncertain business environment, we are currently focused on maintaining more liquidity and not chasing growth till the environment normalizes. Our belief is that by the end of the current fiscal year, this should happen. It's worth just taking a note of some of the fundamental strengths of our business. The core strength that we have is, first of all, there is a credibility of our group. We have perhaps one of the highest promoter shareholding of an NBFC, which is nearly 50% today. Our balance sheet strength is also strong. We have amongst the most well-capitalized financial institutions in India. Our leverage today, our debt-equity ratio is 2.9 times compared to 4.4 times a year ago. The last 12 months have also shown that the client selection, quality of underwriting, and our robust internal controls have resulted in a healthy asset quality, with our gross NPA amongst the lowest in the industry for the last 14 quarters. We have been conservative in provisioning, and our provision coverage today is nearly twice that and amongst the highest in the industry. I have great satisfaction that I have a strong board of directors whose emphasis is on high governance. We are robust risk management performance, with risk and legal teams reporting directly to the board since inception, is now actually being prescribed by RBI for other NBFCs as well. With the strengthening of our financial services business over the last 1 year, we are well positioned to take advantage of the upcoming organic and inorganic growth opportunities. In my conversations with investors, I have perceived that investors often miss the point that PEL is a multi-sector conglomerate with a substantial stake in the pharma business, which has been consistently delivering strong performance year after year. And hence, I would like to discuss some of the highlights of our pharma business. In the second quarter this year, pharma business revenues grew by 19% to 1,316 crores versus 1,109 crores last year. EBITDA margins for the global pharma business which accounts for 91% of our pharma revenues, are now at 24%, consistently going up from 20% in the last year. Our EBITDA CAGR for the last 3 years for pharma is 31%, delivering an absolute EBITDA of 533 crores for the first half of the current year. Despite regulatory pressures and price erosion due to buyer consolidation across the sector, we've delivered a consistent performance due to our uncompromising focus on quality and compliance, our differentiated business model of specialized generic products, and capabilities across development and manufacturing services around the world. With over 90% of our revenues derived from niche businesses of specialty products and CDMO, our pharma business is not subject to pricing pressures. During the first half, we successfully cleared 3 U.S. FDA inspections, 8 other regulatory inspections, and 75 customer audits. Our strong track record on compliance and quality has ensured that we have not faced any production shortages and loss of sales due to non-compliance. Due to these reasons, the business has delivered a 16% revenue CAGR for the last 9 years. Our global pharma services business has capabilities across development and manufacture and offer unique integrated solutions across the drug life cycle, which offers us a huge growth potential through becoming growth partners with our clients. With the addition of 30 new clients to the global pharma services business in the first half, the order book sustained the strong advancement seen last year when we had added 50 new clients. In the global pharma product, we set up a strong sales and distribution channel, which is similar to what we had done when we had the domestic formulations business in India, where we had created a platform which we could then add on new products. We've invested in our global pharma products into a strong distribution network across North America, Europe, and other major geographies. We will continue to add more products organically and inorganically on this platform to boost our growth in future. In our specialty products business, we made 3 new launches in key markets in the second quarter, taking the total number of launches in the first half to 7. We expect the business to continue to deliver strong growth. With the improving EBITDA margin profile on consistently growing revenues, we believe the absolute EBITDA for the global pharma business will be significantly higher in coming years, translating most of this increase into the bottom line profitability of the company. In the Indian consumer products, we also saw a strong year-on-year pipeline growth of 39% with revenues at 112 crores, and the first half revenues have grown by 53% to 222 crores. Again here, we have created an India-wide distribution network and are growing this business by adding products organically and through acquisitions. I'll now move to the Healthcare Insights and Analytics, the DRG business, where the first half revenues we have grown by 14% to be at rupees 652 crores. EBITDA margin grew to 24% during the quarter on account of streamlining the operating processes, and our India-based employees now account for 35% of our total employees. Our strategy for future growth in DRG is to focus on cutting-edge technology and to provide unparalleled client value by offering integrated solutions to grow our presence in the markets other than the U.S. In conclusion, in the past 1 year, we have more than delivered on our commitments made in the last few quarters. We have significantly brought down our CP exposure to near zero by November end. We improved the borrowing mix by raising long-term funds, further diversified our loan book by making it more granular, reducing single borrower exposure, and increasing the share of retail lending. As we expect uncertainty to persist for the next 6 months, our focus is to continue to preserve more liquidity than focusing on growth. The pharma and healthcare insights businesses continue to consistently deliver strong performance quarter after quarter, acting as a natural hedge and bringing a higher stability in the company's performance, even in the most volatile environment. We will continue to build on the progress we made in the last 1 year and capitalize on both organic and inorganic opportunities. We had also made a commitment in the last quarter that we would be raising additional equity, of bringing in equity into the business of about 8,000 crores. And I'm glad to mention that we have made sufficient progress in that and now have now asked for a board meeting to be held this Friday to deliberate and decide about the instrument of new equity issuance, the size would be in the region of $750 million, and to decide what form the equity will be and the timing of the issue. Obviously, this is subject to regulatory and other clearances. We will give more details on the issuance post the approval of the board of directors meeting on the 25th. During this period, we had committed to raise equity, and we are doing it. And in the interim, we've had some rise in the cost of funds, as I said, where our cost of funds is today at 11%. But I believe that with the raise in equity, we should come back to normal levels in cost. With the planned equity raise that we are going ahead with, we remain extremely well positioned to grow organically and inorganically across the sectors we operate in. We have a detailed and granular plan for this growth strategy and would like to share the same in the near future by scheduling an investors meet sometime in mid-November, soon after Diwali. With this, I once again wish you the best wishes for Diwali and a new year. Thank you.
Operator, we can take questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Manish Oswal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity. So my question on your capital raise, we did sell Shriram Transport investment. Our current leverage position is quite comfortable. So, I mean, at the current valuation, why we are raising when the balance is so much comfortable? And secondly, when we are saying the inorganic growth opportunities, so which are the segments we are looking at in terms of inorganic opportunities, sir?
So, we believe, let's look at the whole scenario today. Our belief is that well-capitalized companies will do better in the future. Consolidation is taking place in this industry. That means that there will be fewer players as far as the NBFC sector is concerned. We also expect that during the next few months, there's going to be more and more turbulence. Every day you see some, bad news coming in the NBFC sector. Therefore, those companies, those NBFCs which have capital today are going to remain much stronger in the future. So we are not playing here for 6 months, 12 months. We are taking the long-term view. And that's why my belief is that it's better to have equity today because the returns on the equity that you will get will be much higher today than what you can, which you will get in the future. That's one. Second thing is that, therefore, we believe that we are quite adequate. Today, it's not so much of the debt-equity ratio. More important is to have more liquidity in the system so that any shocks that come into the system, you should be in a position to bear. That's why we've raised equity. In organic sectors, today, there are many opportunities that are coming up. As I've said before, and this we have demonstrated over the past across different businesses, we will only acquire or look at those areas which have a strategic fit with us and where there is value. So even if it was to be entering into, let's say, financial services, we would look at the quality of the company, the quality of the book, the culture of the people, and if they all fit and if it makes economic sense, we will do it.
Sure, sir. The second question is pertaining to the 18 deals which are under stress. So what is the current size of the stress in our book? And secondly, what is the resolution update on the same?
Yeah, hi, this is Qtr2.
Yeah.
So, to answer your question, out of the 18 deals, we have actually resolved all of them, and 4 deals are work in progress, which I think in the next 30 days will also be resolved. So I want to confirm that. And happy to know that the size of the 4 deals cumulative is actually less than 600 crores only now. So that's the first, the answer to your first question. What was your second question?
Second question is what is the, I mean, whether the number of deals has increased or it remained the same, or what is the status?
No, actually it is decreased.
Okay.
Yeah.
Thank you. Thank you very much, sir.
Thank you. The next question is from the line of Sandeep Alamraju from L&T Mutual Fund. Please go ahead. Sandeep, your line is unmuted. Please go to the question. Seems there's no response from the line, sir. We'll move to the next question. That is from the line of Subdural Sarkar from Mount Intra Finance. Please go ahead.
Sir, just one question. If you can give the breakup of yield on particular businesses, like what is the yield on commercial real estate, what is the yield on residential real estate, what is the yield on our housing loan business. That way, if you can give the breakup.
Yeah, let me give you the answer. So let's break it up a little further. In the real estate, if you look at structured deals, the yield are 16% plus, northward of 16%. If you look at our book on construction finance, it's in the range of 14.5%. Then if you look at, and both for resi and commercial is the same. For the CFG portfolio, which is the non-real estate, the yields again for structured deals are north of 16%, so in the range of 16 to 18%, and 13.5 to 14% for senior debt. As far as the yield for housing finance goes, it's in the region of 9%.
Just a follow-up question on that, like our cost of fund is around 11% and housing finance yield is around 9%. So any thought on that, sir?
So
why we are trying to, what is our thought on that, sir? Since there is actually maybe a negative yield currently, so what is our thought on that?
Not really. Let me explain to you. At the end of the day, today the Treasury is giving risk-based pricing to all the businesses. So, for example, a structured debt would get a higher costing when they do the deal, whereas the least risky portfolio today is the housing finance. So, their cost of funds actually allocated by Treasury today is 8.5%. So, it's not that the cost of funds are higher than the yield, because at the end of the day, you have to allocate risk-based pricing to the businesses.
Yeah, I understand, sir, from a risk-based objective, I understand that since housing finance is the lowest cost, so obviously we are, that have a value. But, sir, like in simple terms, are we making any spread on housing finance business, sir?
You have to, let me explain. Housing finance, we are 2-year-old. At the end of the day, you have to look at housing finance in a 5 to 7 year horizon. And why are we doing housing finance? It's because there are a lot of advantages. It gives you granularity of the book. As we move towards the 20-30% of our book being more granular, the entire cost of funds of the entire book, including wholesale, comes down, which more than pays for the low yield of housing finance. So that's the way you have to look at housing finance.
Okay, sir. Perfect. Thank you, sir.
Thank you. The next question is from the line of Shivam Agarwal from Compounding Capital. Please go ahead.
Hello. Hello.
Yeah, go ahead with question.
Yeah, go ahead, Shivam.
Happy Diwali, sir. This is to ask, when the promoters have such a strong understanding of the real estate business, then why are we keen on reducing our exposure to such business when it is yielding us such good yields?
You know, sometimes I really wonder what investors want. If we are too much in real estate, people say you're concentrated in one space. We also understand that you have to have a balance. We understand real estate, we see the yields are good, but I think people want granularity, they want diversification, and that's the way to go. So we are going to go in that way now. That's the strategy going forward.
And sir, one more question. Like you said, we will focus on consumer lending also. So are we going in consumer lending the kind of credit cards, or it will be just the housing finance business?
So it will be housing finance. It won't be credit cards, but in the future we will also do other consumer lending, which will not be via credit cards, but another way.
Okay. Thank you so much, sir.
Thank you. The next question is from the line of Alpesh Mehta from Motilal Oswal. Please go ahead.
Hello. Good evening, everyone, and congrats for the decent set of numbers. So first question is on the cost of fund. I believe you have reported 11% for the first half, or it is for the second quarter?
It's for the first half.
That means for the second quarter, our cost of fund is around 11.8. Is that because we have reported 10.2 for the first quarter? So just
yeah, it's whatever. It's the derivation basically that you can do.
Okay. Second question is on the pharma. When I look at the segmental results, pharma plus IT both put together is around 15,000 crores of total assets, and we have reported the net worth of around 4,800 crores allocated to these businesses. So the debt level of both these businesses are around 10,200 crores. So any breakup on that front would be very useful.
So the overall debt in pharma is about 4,100 crores. And the balance is in the healthcare insights and at corporate level.
So there is some unallocated debt also which is there, which has been added. If you look at the footnote on the presentation, you will find that.
Yeah, unallocated number is there.
Yes, yes. So it might be looking higher, but it's not actually that high.
Okay, and the Shriram Transport stake sale, I believe we received around 2,300 crores, wherein we allocated around 1,700 crores to FS business in this quarter. Any reason for not full allocation or any other business that we have?
So frankly, the debt equity ratio, even when you allocate at 1,700, is below 3 in the financial services business. So that's more than enough.
Okay, but so we have certain debt to equity ratio in mind while allocating capital to the FS business. So is that the way to look at it?
No, that's not the way, but we felt that it is prudent today. In fact, when we raise equity now, the additional equity, the debt to equity in financial services today will go down further because it will come down to below 2 now after the fundraise. And then it will slowly go up as we see the environment changing. We will start growing the book.
Okay, so two related questions to this. If we have a plan of raising around 8,000 to 10,000 crores of equity in this year, obviously part of that would be through Shriram Group. But any ballpark number, how much would be allocated towards the FS business from this?
I think we'll decide now. Over time, we'll decide. We'll let you know. Let's see the opportunity. After all, please remember it's fungible. It all comes into the company. We will move it one way or the other. Today, as far as lenders are concerned, at a 2.8 debt equity financial services is adequately, there's enough leverage possible. We look at opportunities and then allocate the capital. It is at the parent, it is fungible.
Okay, and two more questions. So one, would any guidance on the growth part now, considering the environment, because we have moved down from 50% plus to almost a flat growth now. So anything...
in the March 2020, I do not expect any significant growth in the book. We are keeping it flat, as I said. I think our focus is on liquidity. Beyond that, we expect that with consolidation take place, we will talk of growth. Details we will share with you in the investor day. I don't think we should measure performance for 6 months now. More important is to strengthen the balance sheet, to strengthen the company, and then the growth will be enough opportunities. On the other hand, I want to just come back to the pharma sector. We expect that the growth rate on the top line will be about 15% growth on the top line, and the bottom line, the margins which we have of 24%, which itself is a 20% growth over last year, will continue to remain. I expect that the DRG performance will grow by about 10% on the top line and significantly higher on the bottom line.
Alpesh, just to add on what Chairman also mentioned is that, when we speak to investors, frankly, no one is worried about growth because everyone realizes that, in this environment, competition is going down quite a bit in the sectors where we are operating. So there are, frankly, no questions on growth because people know there is enough opportunity to grow. And once the equity comes in, I think, then, the growth is sort of obvious to happen.
Okay. And one of the comments, Mr. Piramal mentioned that the top 10 exposures are going to come down from 30% to 20%. So if I look at your FY19 book, the top 10 exposures were around 18,000 crores or so. And with this book, the number is likely to be around 14,000 crores. So how, since obviously it's a great thing that you guys are able to reduce the exposures, but if you can elaborate further about the strategies that you guys have adopted in terms of reducing those exposures.
Yeah, so Kushru Jina here. So in fact, just to tell you, from 18,000 crores as on date, as we speak right now, it's already down to 14,500 crores. And we will bring it down to around 11 to 12,000 crores in December. So the number of 14 is already there. We already done it in this from June to October. And in March, in fact, we'll be somewhere around 10,000 crores. How we are doing it? It's through mix of cash flows, which is there from good projects. So I'll just dwell upon this also for a minute. In this whole journey of the loans which we have given, what you should also realize that today our portfolios have become mature. So what I mean is that today more than 40% of our portfolio in real estate is near completed projects. So obviously the cash is coming faster. And only now less than 20% is in the early stage. And also because we haven't done many deals, our moratorium, the deals on the moratorium has also come down to only 18%. All this is helping us and of course the quality of the book which is helping us get refinancing because we are consciously wanting to bring the single borrower down because that was one of the things we spoke four quarters ago in September 18 and that's what we are doing. So our idea is that by March we will bring all our accounts below 15% of our net worth. And also the top 10 will be below 20% of the total loan book. This is the path which we are taking.
Okay, and the moratorium would be what, around 18 to 24 months on our loan book?
Yes, 19 months.
Okay, and lastly, on the new tax rate, have we moved to the new tax rate or any plans to move?
We are actually still evaluating both the advantages and what are the consequences of this, and I think we are not in a hurry. We will let you know in the next few weeks.
Okay, thanks and all the best. I will come back for the more questions. Thank you.
Thank you. The next question is from the line of Aditya Jain from Citigroup. Please go ahead.
Hi. The securitization deal of wholesale loans which was concluded by you recently, if you could give some color on it. So who were the investors? What sort of credit enhancement we did as part of that deal?
Yeah, so this was the first deal in India which was done for wholesale real assets. So basically it was a mix of both real estate wholesale assets and the non-real estate assets. The pool was rated AA plus by CRISIL. The total pool which we had given was 3,300 crore with a 20% cash credit enhancement. And we raised funds in the region of 2,400 at 10.5% coupon. In fact, you'll be happy to know that 10% of that pool has already been prepaid. And it was invested by a whole lot of investors, yes.
And the rating that we got from CRISIL was
AA plus.
So this was
the first AA plus. The first time a wholesale, especially a real estate pool was rated AA plus.
Thanks. So just to confirm, you mentioned 3,300 crore was the total size and you raised 2,600 crores?
2,372.
2,372 and at what rate?
10.5% coupon.
10.5%. So clearly more of these, if possible, you would like to do.
Yeah, we will evaluate in our business model at any given point of time, if a securitization because at the end of the day, you need to churn your book also. So this securitization can become a part of your business going forward.
Got it. And could you give us an update on the LODA exposure? Because it was planned to be reduced to around 26 billion by September. How are things looking on that?
Yeah. So as you would have read in the papers that the LODA has done very good sales in the last 6 months, and in fact they have started the Diwali with a bang with 320 crores in the first 7 days. So this was a conscious strategy which was adopted by both LODA and us, where in this market, because he is near to completion, he asked for a 1 quarter exception that he does not prepay us, because anyway he's prepaid 1 year down the line. So we did not insist on prepayment and use the funds to accelerate his construction, and which is what showing is now in the sales numbers. So let me tell you, in the next 3 to 4 months, you will see a reduction of around 450 to 500 crores in our exposure. So while our exposure right now is at 3,100, you will see going forward a reduction of 400 to 450 crores coming down. But it did not reduce because as an exception, we thought it makes more business sense for him to construct faster, and that's actually reflecting in the sales number now.
Got it. And then in slide 22, in the borrowing mix by both instrument and investor type, there is an others part. So what exactly falls into that segment?
Just give me 1 minute.
Sure.
Other category will be all the under ICDs, yes.
Sorry?
ICDs from corporates.
Got it. And on the investor side, so that would be corporates and...
Yes, corporates.
So 9% of borrowing mix by investor is corporates?
Yeah.
Okay, and just to confirm, the amount which is under principal moratorium, you mentioned 18-19% in this quarter. So the amount was much higher in the past quarter, right?
Yes, it was 35%.
Right. So is this a very volatile number, or the move should sustain?
No, the move is going down because logically, if you're doing lesser new deals and your older deals are, as I explained just now on the call, that your older deals are becoming much more mature. As I mentioned to you that more than 40% of my book now is completed and almost completed projects. So definitely the cash is being thrown. In fact, even deals which were under moratorium have started prepaying us. And just to give you a number, in fact, less than 4,000 crores is only in moratorium. Even if you look at the number, less than 5,000 crores, sorry. If you even look at the number, it's now insignificant compared to the overall book size now.
So there has also been refinancing, which we talked about, of the deals. And the book sort of remains consistent with retail mix going up. So, there are a couple of reasons for what you're asking.
Got it. Really good to see. Just lastly, on the securitization deal, was there any investor who took more than, say, 50% of the amount?
So we don't want to disclose the breakup. As Mr. Jijina mentioned, there has been mix of investors, and that is what we would like to say.
Got it. Thank you. Thanks very much.
Thank you. The next question is from the line of Nischint Chawate from Kotak Securities. Please go ahead.
Hi. Just taking up, from the same question, on slide 22 of the presentation, 6% securitization, so that essentially refers to this transaction, is it?
Yeah.
Plus a small transaction on retail.
Sure. And when you are today reporting a loan book of around 53,000 crores, that is after the transaction, or is it like the gross book?
No, this is the gross book.
Mm-hmm. Okay, so the transaction that you sold would, I mean, technically from a balance sheet point of view, I should be subtracting this from 53,000 crores.
So with the new accounting standards coming in, and wherever, we have been providing credit enhancement, there the book is not derecognized, and the capital on the book which you have securitized continues to be held back. Accordingly, we have shown the AUM along with the securitized book, and the capital is also accordingly allocated to that book.
On the provisioning part now, if I really look at the provisioning ratios, this has gone down from around 1.85% to 1.8% between the June and the September quarter. And your book has gone down as well. So mathematically, does it mean that you have done a provisioning write back in the quarter?
So provisioning will be done basis what kind of book you have. So if you see the retail mix has gone up and the book in terms of size has also changed. And so accordingly the provision also, changes because there are percentages applicable on every kind of nature of the part of the book.
No, fair point. So I'm just saying that, my math that, there was a net provisioning write back over the last 2 quarters. I think that's fine, right?
Yeah, so rest is all math that I'm sure you can do that.
Thank you very much. Okay. Great. Thank you very much.
Thank you. The next question is from the line of Rohit Koti from Marshmallow Capital. Please go ahead.
Thank you for the opportunity. Just want to confirm what Mr. Jijina said previously. It's 18% or 19% of the total loan book that is under moratorium and principal is more of a bullet prepayment. Is that correct?
Yeah, that's right. But we are this is regarding the residential real estate we are talking about.
So it's 18-19% of the residential real estate book and not the whole book.
So if you look at the total book, it will be far less.
Less than 10%.
Yeah, less than 10%. But that is not the right way to look at it. So we are giving you a number of 18% of the residential real estate book.
Understood. Thank you. The second question is, you in very great detail talked about reducing the top 10 exposure that we have. By March 2020, you expect to bring it down substantially.
Yeah.
But Chairman mentioned that our loan book will probably remain flat. So does this mean that we are seeing growth in certain other segments, and what are the areas where we expect the growth to continue?
So one is Chairman has not guided that book will remain flat or anything. What he's saying is that, we will focus more on liquidity than growth. That doesn't mean we are guiding you anything on the growth part. Having said that, the mix continue to change. So, yeah, if that answers your question.
I'll just add, I think there will be a lot of questions. So just to add what Chairman said, I think what Chairman said, I just want to summarize that what are we saying? We are saying that our paramount importance right now is the liquidity. That doesn't mean that we won't be doing business. Somebody asked that you guys are so good in real estate, why are you getting out? We are not getting out. All we are saying is that we are changing the way we used to do. We will have granularity, single borrower exposures, we will diversify. That's all what we are saying.
Co-lending.
Through co-lending, etc. And also, we will grow our retail book. That's all what we are saying. So I just thought that I'll summarize it.
Understood. And coming back to what Mr. Chairman, what Mr. Piramal mentioned about how our business is doing so well is giving us sort of a balance in the current environment. And basically, he was talking about the benefits of the conglomerate structure. I was just curious, there has been a change in thought process at the top management level on the demerger. Do you think that a conglomerate structure is more effective as it gives us sort of a downside protection?
There's no rethink on that. I just said in this environment, it makes sense for us to look at even Pharma and this. If you look at questions also, nobody looks at that. But that gives you some stability. In the future, we will see how the environment is and what. And I personally feel this turbulent environment is not going to last forever. This is I say it's a black swan event once in, I don't know how many years.
So similarly, I was wondering, these events sort of...
I don't think we should come to any conclusion today. Let's look at what happens. Let the storm recede, then we will talk.
Okay, sure, sir. And the next question I have is on our housing book, the housing finance book. So we have grown quite well in that book over the last year. While it does give us granularity, I was wondering because it sort of takes away liquidity from the system, does this mean, I wanted to understand your thoughts on balancing the lower cost of funds that the granularity of the book brings versus the liquidity that we mentioned that we are looking to maintain. So could you speak a little more about that?
We have to look at a long-term strategy for the business. In the long term, it's not only the wholesale, you need granularity to get into retail. Today, and any new business, when you start, you will see that the returns are lower. Over time, the returns become better because one is that your cost of actually getting the loans becomes lower because you can amortize it over a larger turnover. Secondly, this retail gives you a better understanding of the consumer and you can extend loans to other products to the consumer. So please don't look at anything just in a 6-month, 12-month period. That's why you need a balance between wholesale and retail and consumer. And also the debt equity ratio the amount of debt you can raise on the retail is much higher than what you can raise on the wholesale. The risk adjusted, the returns are also higher. So it's a mix that we are taking. It's obvious to us that today the retail is much lower, the yield, so we should not do. But that's not the way to look at it. Please look at it as a whole book.
Yeah, fair enough. So thank you for that explanation. It was quite helpful.
Let me add on this because this question on retail keeps on coming. I think one must, besides what Mr. Piramal said, and I think we have also spoken about it before, I think the very important point which is also missing, which we should share, is in the last 2 years, we have put substantial investment in this retail. Today, I would like to confirm that more or less those investments are done in terms of people, in terms of the locations, in terms of branches, in terms of technology. So all that is now in place. The main thing is to bring the cost profile down, which has now started, and you will see the benefit of it percolating now in the next year to 2 years, etc. So we have a plan how to grow the ROE in retail now. So please don't look at the investment phase of 2 years of retail and come to a conclusion. I would like to leave the investors with this thought.
Understood. Fair enough. Thank you. And the last question from me is if you could speak a little more on how you see the debt in the non-financial services business going forward, because I believe, as you mentioned, that global pharma is doing very well, but we seem to have a 4,000 odd crore debt, and there is a huge debt at the DRG business as well. So is there a plan to bring it down, or what is the plan there, basically?
Yeah, so the plan is to bring it down. One is, I think we are seeing that the performance already improved. I think this year we expect that performance compared to last year will be, in terms of profitability, almost 40-50% higher than last year. We have also got enough equity in the system. We are, as I said, today raising more than 5,000 crores even on this Friday when we meet, subject to, of course, the board approving it. So again, there is equity available in the system. So we are quite comfortable, even as a company, on the total debt equity ratio is actually less than 2 in the whole company, including financial services, which is such a large part. So I think there is not much concern. These are all allocations that we can make sometimes internally about how much debt and equity to put. Besides, please remember that we also have the whole Shriram asset which is available, which we have publicly said we will monetize over the year.
Just to add on what Chairman mentioned here, that as we continue to grow on the same trajectory, what we've been growing 15-16% year after year, and with these kind of margins, at the higher growth rate, higher revenue numbers, the EBITDA margins are certainly going to be quite good, and the fixed costs continue to remain the same, and depreciation and all we keep reducing. So the incremental profitability that will come at a higher revenue levels will keep helping us in deleveraging that debt. So you should look at from a long-term perspective and not just today.
Actually, in pharma, the debt is only 3.5 times to EBITDA, which is a very reasonable debt.
Yeah, sure. So thank you for that. I just wanted to know, is going to be downwards, or we plan to keep it as part of our capital structure. That's it. That's it from me. Thank you.
Thank you. The next question is from the line of Kunal Shah from Edelweiss. Please go ahead.
Congratulations. Good set of numbers. So firstly, in terms of, I think you have highlighted in terms of the 18 deals which were there, and I think most of them are near to the resolution or have got resolved. But this 18 has been the number which has been there 2 quarters back. But doing the stress test and what has happened in the real estate environment, and as you clearly highlighted, 18-19% of RE book is already under moratorium. Are we seeing more falling into this stress pool, or is there any change in this overall stress pool in this quarter?
I think, first of all, let me rephrase. I think let's take a step back. When this whole mayhem happened 1 year ago, what we did was, and we shared with you, we stress test all our deals, not necessarily that they were in bad shape. Let me again repeat, and I think it's worth taking that time off. We stress test all our deals on 4 parameters, if you recollect. One was that what happens if the sales price goes down by 20%? What happens if the sales velocity goes down? What happens if the construction slows down, etc., etc.? And then we had come on a number of 18 deals which require resolution. It was not stressed assets. Let me again repeat. Out of the 18 deals, we have resolved, means whatever action needed to be taken, whether to bring down the prices and sell and get more cash flow in, the additional security of land to be monetized so that the additional equity comes into the project, or change the developer, move the project to another developer, all has been done. All what remains out of that 18 deals is the 4 deals which are almost complete but not yet completed, as I said, and the value of these are less than 600 crores. Now, that was the exercise done a year ago. That doesn't mean that we are only looking at that. Last quarter, we shared with you all that with the things deteriorating, we again looked at all our deals from the perspective of that how many deals, even if 30% of the assumption of sales only 30% of the assumption of sales now work out, what is the amount required by these projects? Again, we're looking at all the projects again. So it's a fresh look. And we came to a number of 1,300 crores from the sanction of the construction finance limit of 6,000 crores. So, and that is what we continue to disburse. And that's why you see our projects today as we speak, which I shared with you today, are nearing completing and completing. That's the whole trajectory. In real estate, you have to be ahead of the curve. You have to ensure that the project gets completed so that the sales are faster. Luckily for us, almost 81% of our projects are in affordable and mid-income. And that's why you see the sales velocity on an ongoing basis. I'm sure we can share with you far more granular details. Right from demonetization days till today, month on month, we are collecting anywhere between 700 to 800 crores from our project and around 800 to 1,000 crores of sales even in the month of August and September. So the point I'm making is that 18 deals, the exercise was a 1-year-old exercise, and we continue to keep on looking at our deals on various parameters as the environment keeps on changing. The bottom line is that you have to be ahead of the curve.
Sure. And in terms of the incremental working capital requirement, so last time we highlighted 1,600 odd crores that would be needed, and some of it would have got disbursed. So now where does it stand? And maybe for some part of it was already disbursed, and that's a part of the disbursements, and now the requirement is the lower. Then should we see the contraction in this wholesale book to be much higher than what we saw in this particular quarter?
That's what we said. I think, let me answer your contraction question. The contraction will come because of natural flows of money into the escrow because of the projects are getting mature and also refinance. Coming to your other question, your first question, last time if you recollect, we said that till March 20 we would require 1,600 crores. Again, that was the number as on that date. It cannot be a static number. Today, we require 1,300 crores till July 20 now. So we keep on doing this all the time. You have to be ahead. It cannot be a static number.
Yeah, sure. And in terms of the capital raising of, say, 8,000 odd crores, which we are looking at, maybe in terms of this utilization, so one is the leverage levels are quite low, and definitely given the real estate exposure that towards the developer, we need to be quite comfortable out there. And our CPs have in fact run down. Earlier we were looking at in terms of maybe if it has to run down, whether we are sufficiently capitalized both in terms of borrowing as well as equity. But now what would be the utilization for this? Is there any inorganic opportunity also which we are looking at in any of the product segments, or it would be purely the expansion on the housing-related sectors?
See, as we look at we will share details of growth as I said, in the Investor Day in middle of November. But I can say prima facie that in a environment where consolidation is taking place, there will be opportunities that will keep coming up. One is opportunity to grow. As you've correctly said, we don't need this capital to bring down debt. As it is, our debt-equity ratio is good. But we need this firepower to grow organically, and I believe that you will get good inorganic opportunities at a good value. That's the time we will take advantage. So this is the time to be ready with firepower so that any opportunities are there, we can look at them and take advantage of it.
Yeah, please.
And that too is related.
Once again, please perceive this equity raise only as a growth capital.
Okay. Okay. Yeah. Thank you.
Thank you. The next question is from the line of Ashi Anand from Allegro Capital. Please go ahead.
Yeah, thank you. My question's been answered.
Thank you. The next question is from the line of Vivek Joshi from Bandarpush Capital. Please go ahead.
Happy Diwali and congratulations for an excellent set of numbers in such tough times. I have just two quick questions. That given that we are raising 5,300 crores of equity and we pay out dividends of around 550 crores, would it be advisable to not pay out the dividend and conserve it and limit the equity dilution? And are there any quick update on the Phytocare demerger, merger?
Okay, the Phytocare demerger is just waiting for NCLT to approve, and there is a long backlog in NCLT, so there's nothing to be done. They have to just pass the order. I wish I can tell you when, but I'm told it will be sooner than later. That's all I can say on that. In equity, as I said before, it is important in today's environment to have a strong balance sheet. And equity is not something that you keep taking. It is taken once in a while so that we strengthen ourselves, because in the future, I see that those NBFCs which go through this tough time, there will be fewer of them. There will be many more growth opportunities to grow, both in terms of organic as well as inorganic. And hence, I feel that this is the right time to raise equity.
No, I completely buy the point. I'm just saying, wouldn't it be more prudent to not give out a dividend also to conserve the capital?
That's 500 crores. This is 5,000. It's 10%, no? And there are many people who live on the dividend. I have to take into account every shareholder. You must be one of those large shareholders for whom dividend is not important. But I have individual shareholders whose life depends on dividend. So I cannot take a view only of what is good for you or me. I have to take for all shareholders.
Thank you so much.
Thank you. The next question is from the line of Tushar Mandane from Motilal Oswal. Please go ahead.
So just on the pharma side, the first half we are at 24% EBITDA margin. We did in first quarter FY2022. So effectively second quarter 26% EBITDA margin. So any particular reason for lower EBITDA margin target of 25% for FY21?
See, pharma, it's not, these are all contracts and all. It depends on, it's not the regular flow. Sometimes there could be a better product mix, sometimes less. So therefore on an average you have to take. So don't please go on the basis of one quarter what happens. Therefore you see the trend. If you look at our trend over so many years, we have said our CAGR on top line and bottom line is going up. So please don't look at it quarter by quarter. Actually, if you look at it, usually in the last quarter is where we get the highest sales.
Okay.
Even the first quarter of the current year, the sales were a little lower because the last quarter of last year was higher. So please don't look at it quarter by quarter. It will give you a misrepresentation. Take it over a year's period.
Okay, sir. That helps. Thanks a lot.
Thank you. The next question is from the line of Abhishek Lekha from Nest Wealth Management Services. Please go ahead.
Yeah, thank you for the opportunity. And congrats for a stable set of numbers. I'm wishing you all a very happy Diwali. And coming to the point, on the pharma space, it's been mentioned like re-entry into domestic formulations. It is something that you have already planned, or how it is?
No, again, I think we, as far as re-entry into domestic pharma, we understand this is a space that we know. We've had a good track record in the past. But we have to get the right opportunity, and it has to be at the right valuation. So it's not that we have identified something. We are just saying that we are ready. We are looking at opportunities. But unless and until we get something which is of adequate quality and it is of right value, then we would do it.
Is it like, can we also do it on an organic basis, or probably we are only looking at an inorganic?
No, I don't think we will go organic. It will be inorganic if it was domestic, branded, generic formulations. As far as the way we are playing in the domestic market is the OTC space, where we are going organically as well as through acquisitions.
Okay, thank you. And second part is like which quarter or particularly which year probably will be like demerging or probably like IPO kind of for pharma business for us?
I think, as I said before, we will see in the midterm. It's not, today I can't give you a definite date.
Any ballpark, like some ideas?
No, the market, the whole environment in the country is so volatile. I want it to settle down. That's the time when we can talk about these things.
Okay. Yeah. Thank you so much.
Thank you. The next question is from the line of Mitul Mehta from Lucky Investment Managers. Please go ahead.
Hello. Yeah, sir. Good evening, and wish you a very happy Diwali to the entire team and Mr. Piramal and Mr. Kushu. So my question, your earlier answer to the loans given to the real estate developer, you did mention about Lodha. I have a specific question. If you could also, give us some sense on what's happening on the Omkar Realtor side, because that also seems to be kind of hanging in fire. So, if you could just help us to understand, because the project is not completed, we have an exposure to that developer, and I believe some of the exposure has been converted into inventory on our books. So, if you could just help me to understand the whole this.
I think, let me again clarify for the nth time. I think we are doing it every quarter. We have no exposure to Omkar 1973 either by way of a loan or inventory. First. Second, our exposure to Omkar, let me spend some time on it, is basically on two projects, one which is run by L&T Realty and one which is run by Piramal Realty. The one which is run by Piramal Realty is the Dhobighat project. The Mahalakshmi project, where we had given 1100 crores to Omkar, which is nothing but today receivable funding in parts. Because in other words, today Omkar has completed his obligations in Mahalakshmi. Today, I'm sure you are aware that a lot of sales have already taken place. 525 lakh square feet has already been sold by Piramal, by Piramal Realty. And 40% of the proceeds will automatically come into the Omkar account, which will be swept by us, 100%. So Omkar has no role to play now there at all. So in all practical purposes, it is the receivable funding now. If you really look at it, in practical purposes, it is the receivable funding of 1100 crores against the performance of Piramal Realty. Number one. Number two, we have loan to Omkar in the same way, you can call it receivable funding against the Parel project of L&T, Crescent Bay. Again, there, if you look at it, our exposure is somewhere shade lower than 400 crores, where today the sold receivables, which will now come into the escrow account, which is 100% swept by us, is more than 500 crores with another 800 crores of unsold receivables. So both are absolutely safe projects, but the money comes from the Omkar escrow account, and that's why this question keeps on repeating to us that why is the loan to Omkar? While we are talking on Omkar, I also want to confirm that the way we are structured in our loan to Omkar for these projects are IBC proof.
Okay. Great, sir. Thank you very much.
Thank you. The next question is from the line of Lalaram Singh from Vibrant Securities. Please go ahead.
May I know within the housing book, how much percentage comes from the captive developer financing which we have done the projects?
So almost 50% comes from our developer projects.
Okay. And within region-wise, can you split the housing book, north, west?
Yeah, so the maximum comes from the MMR region, which is around 45%, and then from the other cities like Bangalore, Hyderabad, Pune, etc.
Got it. And you said that most of the investments in terms of distribution and people have been made. So what kind of loan book is possible with the current infrastructure which we have?
Today, with the current infrastructure which we have, we can actually go up to anywhere from 700 to 1,000 crore per month.
Per month?
Yes.
So let's understand why Mumbai region is higher, because we started from Mumbai, and then gradually we are expanding across. So as we go on, you'll start seeing growth across other regions as well on the book, and that's where the opportunity is for us.
Got it. Also, any particular reason why in this quarter the disburse or the loan book growth has been pretty marginal quarter on quarter? So, because you're doing 1,000 crores, I think every quarter more than that, now it is less than 300 crores in this quarter.
I think, as I said before, our focus is really to play in the long term, and for that we should look at liquidity today and strengthen ourselves so that we can take advantage of the future growth opportunities.
So it is nothing to do with the demand side, right?
Go ahead.
So do you mean to say that it is nothing to do with the demand side, just that we are being more conservative, more cautious?
In fact, the way I look at it, the demand will, because there are fewer providers of now loans, the demand will be quite good because there are fewer providers and you will get higher NIMs in the future.
In fact, if I may just rephrase, we used to always last 4 quarters talk about consolidation will happen. I think consolidation has happened. And if you really take a step back and understand how many NBFCs, large NBFCs are still there, you will get the answer.
Got it. And within the housing finance and inorganic route which we have been talking about, so will it be a combination of buying out books or also entire NBFCs?
Yeah, as Chairman said, it could be a combination of anything. At the end of the day, when you are buying a company, for us, the culture, the liabilities, the hidden liabilities are very important. So it could be, I think today with so many NBFCs going down and hardly anybody remaining, I think you can easily take a guess of all the types of, you can pick and choose the portfolio, you can buy the entire portfolio, you can pick up the company, you can have a company without employees, everything is there available in the market.
We will focus on value creation, basically.
Yeah. And whatever we will be looking at will be after extensive due diligence.
Also, we are in for the long term. It's not that today we want to build a book and this is a long-term franchise that we are developing, so we will do what is in the best long-term interest.
Got it. And do you want to give some color on the commercial lending side, because I believe that also is a very lucrative space and is pretty resilient even in these scenarios. So how do you want to play that sector and Piramal's positioning in that commercial estate?
I think it's a good question. Last time we mentioned that, in fact, one of the learnings is that going forward, you are right, it's a very lucrative space. But having said that, even in the RE, we said we'll restrict ourselves to single borrower exposures. Even in the non-RE space, this is the commercial space you're talking about, which we call CFG, the commercial group. There, we had shared with you all that we will pursue cash flow based and hard security based lending to the operating companies. As far as the mezzanine deals go, we will do it through a fund structure, and in fact on that we will be announcing a few of these initiatives hopefully in the next few months.
Got it. One data point if you can give me, in the stage 1 loan book is 52,000 crores. So if I just break it up into what would be 7 days and above, 7 to 30 within that?
What's the question?
9 to 7 days. Within the stage 1 loan book, can I get a split of that into 0 to 7 days and 7 to 30 basically?
Well, that we will have to come back to you. Yeah. Because normally we track it on a 0 day or 0 to 30, 30 to 60, and 60 to 90 and so on. So for that, we will come back to you.
Okay. Okay. One last question is on the healthcare analytics business. Can you share, we have seen a very smart turnaround over the last 2-3 quarters where I think growth has revived. And with the change in the employee base to India, we have seen the margins also going up. And in this IP, we talk about entering new geographies beyond North America. So what is the vision which we have for this business? And even in this, do we foresee the opportunity for inorganic growth and just a broad view on this business for the next 5 years?
So in this business, as you know, what are we doing in this business? Today, if you look at the environment, there's a lot of data that is generating out of healthcare. Also, healthcare costs globally are going up. So we sit at the confluence of this, at the intersection of data for healthcare and healthcare costs going up. Therefore, there's a good demand for these products. What we are trying to do is to see that how we can, and today India has a good strength as far as data scientists, analytics, and all are concerned. So we're trying to move some of the activities into India so that the costs are more manageable, which is what we have done, as you have seen. We have now 2 operation centers, one in Bengaluru and the other in Gurgaon. And we are now trying to create more products and platforms which people, global pharma, global insurers, and hospitals can take advantage of. So going forward, about what we will do in this space in inorganic way, would be small acquisitions that we would do, where there is some technology, there's some expertise that we want. By and large, otherwise, I think we would like to grow organically more.
That is helpful. Thanks a lot and all the best.
Thank you. Ladies and gentlemen, due to time constraints, we'll be able to take one last question. That is from the line of Rajiv Agarwal from Durdarshi Advisors. Please go ahead.
Yeah, hi. One question is, I think Piramal has always been counter-cyclical, and just raising capital at this point, do we think we can, given where our valuations are? I just wanted to get a sense of, are we structuring the capital raise in such a manner that we are not penalized for the current low price that we have?
I think this is I think we should take advantage of the opportunity. Even if you raise capital, the price is low. But the opportunities that you will get are also where the valuations are much lower. So net to net, you are not badly off, if I think. So suppose, let me explain. If you are going to do, let's say, inorganic growth, the valuations which could have been of businesses could have been 3 times book, 4 times book only a year ago. Today you may get it at book or below book. So relatively you are well off. So the power today is not so much in valuation. The power is into have the liquidity and the availability of that firepower. That is what we are looking for. Even in growth today, even if you do organic growth, our belief is that the NIMs will be much higher. So then the return that you will get on your equity will be good. So look at it in a broader sense. Let's not look at it, what's the valuation.
Got it. Okay. The second question is on the cost of borrowing. We talked about it moved from 10.3 to 11%. Could you just give a sense of what would be the incremental cost in Q2?
So frankly, please look at this cost of borrowing as a one-off in one quarter. When equity comes in, let me tell you, the cost of borrowing will go down. So if you make projections based on this cost for the future, you'll be making, if I may say so, a mistake. Costs will come down. To us, please, that's what I'm trying to say again and again. I see that the NIMs can go up today significantly if you have liquidity. Cost is not important today.
Got it. One additional question is...
I think we are getting into a little bit of time constraints, so we would like to restrict the call now, especially, a couple of questions you've already asked. If you have more questions, you can always send us and we'll help you respond to your questions.
No problem.
Thank you. Ladies and gentlemen, that would be the last question. I now hand the conference over to Mr. Hitesh Datta for closing comments. Thank you, and over to you, sir.
Thanks, everyone, for joining the call. Please feel free to reach out if you have more questions. We'll always be able to help you out. Thank you.
Thank you very much, sir.